Hi everyone, welcome to a Black Ink Economics video. Today I'm going to talk about gold, specifically because we are printing money. The US is printing money like crazy right now to try to get past this um, quasi-deflationary, concerning time where no one has a job, no one's buying anything, and their attempt at printing money is an attempt at getting things jump-started again, right? So when a company, or excuse me, when a government prints money, they create inflation. And inflation is the same as the value of a dollar going down. It's the same as the price of goods going up. And it's the same as safe havens all becoming attractive. So safe havens would be precious metals, gold, silver. I've heard that traders in the past have used Swiss francs as a safe haven because of how tightly controlled their monetary policy is. But gold is a really special trade to make when there's heavy inflation. So the last time we printed money was 2008. There were two checks that went out in 2008 and 2010, or 2009. Can't remember if they were back-to-back years, but they went out in that time because we had suffered a massive recession, the housing crisis, and the checks were there to get us through it. And it caused, when you create extra supply of anything, it causes the value of that to go down. So in this case, that thing that we had extra supply of was dollars, printed American dollars. And that caused the value of the dollar to go down. And very smart people already know that's what happens, right? That's not a subjective opinion. That is what happens when there's more supply, value goes down. And so people would put their money out, take it from cash, turn it from American cash into anything else that wouldn't lose value. And one of the big ones is gold. And you can actually look, first what I want to do is look at GLD, which is just a gold tracking ETF, and look at on the left side of my screen here, look at 2008, there's that dip, end of 2008, that was the recession, that was the housing crisis, and then immediately gold recovers and it starts its journey. That dip was the initial deflation concerns which always accompany a major recession. It's the concern is people aren't going to spend their money. And then the danger is if you don't buy something because you think it's going to be cheaper tomorrow, then you'll do the same thing tomorrow and do the same thing the next day, and it'll cause the economy to sputter. So deflation is a very, very big threat, but the easiest thing to do to fix deflation is print money. And that's a very easy thing for the Fed to do. And that's what they did in 2008. They printed money, they sent us all checks. And for the next 4 years, 2008, end of 2008 until the end of 2012, really, middle to the end, gold was on a rocket, was on a tear. And that's totally expected. That was the effect of inflation and money supply. And so you can capture it in these ETFs. You could capture it by buying physical gold. You could do all kinds of things like that. Or you can actually go into the miners, because miners, gold miners, have assets in the ground. They calculate how much gold is in the ground. They drill a hole, they measure how much they got out of that hole, and they do the math to figure out how much they got. And that is calculated as assets in the ground. If the value of gold is going up, even if they haven't mined it yet, their company is worth more. So there's miners that are worth looking at. And this is like nostalgic from 2008. I remember a lot of these. I don't have all my lists put together yet. This is just one I put together today, but here's my list of gold companies. I'm not looking for low float gold companies that we would use technicals to capture spikes. I'm actually looking for solid, fundamentally solid, strong earnings. They've made it through past recessions. They certainly had to have made it through 2008 for me to be super interested. I have one there, obviously, at the top that didn't, but the idea that there's an IPO right now is so interesting, so I left that there. But look at here, so very top one, Eldorado Gold. Just look, that dip at right before 2009, that dip is the 2008 recession, and then look, from there to 2012, it doubles, right? And then same thing, if you look at BVN, there's the dip in 2008, right before 2009, and it goes from 21 to 51, more than doubles. CDE, actually, because it's been around for so long, that 2008 is much harder to see. So actually, we can't really do the analysis there, but I remember playing them in 2008 because they actually had a dividend that was really impressive, and they don't have a dividend now. But I always believe that if a company had a dividend in the past, their goal is to create income. And I'm very interested in CDE for a long run thing if they're going to bring back that dividend. BTG, if you just look at the far left, BTG is 1, 2, 3, 4 from the bottom. Far left is 2009, so we don't get to see the 2008 dip so much. It's kind of there. But at 2012, it goes from 61 cents to $4. That was huge, right? That was bigger than, it was more than double. American Gold and Silver Corporation, the data is skewed from that dip in 2000, so it's harder to research this from this. But here's DRD Gold. This is another one with a big dividend, and another one that big dip is kind of making it hard on the small chart. We can try to zoom in. 2008. Well, you can see the dip, and actually this one didn't come up from 2008. So this is one interesting one that didn't go. I do remember that they had a good dividend though. I remember playing them in the past. So it's one to keep on your radar. So that's what I wanted to look at, is the fact that in 2008, 2012, maybe 2011, there was massive runs on all gold companies because gold was going up, because inflation was happening, because we had printed money. That cause and effect, it's constant. You print money, the value goes down. People who have a lot of dollars say, I don't want the value of my dollars to go down. I'm going to put my dollars in gold so that it doesn't happen. And by doing that, they actually also cause gold to go up in value. So it's a really special thing, and it happens over a long course of time. It was a 2-year thing. It wasn't just a quick overnight trade like a lot of the technical analysis we do with the short-term, 1-hour charts. This is more about a fundamental analysis. We printed money. Gold's going to go up. Where should we capture that? Should we capture that in dividends? Should we capture that just in maybe a penny one that, like, whatever the one they looked at, B2B, when it was a penny, went from 61 to 424. That was a huge jump, something like that. Or do we look at maybe this IPO? Equinox Gold shows about the perfect time you could ever choose to IPO for a gold company. So this is the beginning of some research. Everyone should do their own DD, of course, and try to figure out how you're going to play this, because inflation, even if you're not going to play gold, inflation makes the value of your money less. And that is a big way that the top 1% continues to become the top 1% and grow. And the rest of us don't, because the rest of us don't recognize that even though they're printing money and giving it to us, that's actually not helping us. That's helping them, because they know that by printing the money, it's making the value of money go down. So they're leaving money, they're leaving cash, and they're bringing in gold, and they're actually going to benefit quite a bit from a trickle up from that. So the lost value from cash is going to go straight to gold. So that's my spiel. That's what I wanted to talk about here. I look forward to hearing any questions. If you want to email me, theblackинkeconomist@gmail.com. If you're interested in taking one-on-one tutoring with me, I do that with 1 or 2 students a week. I also sell a textbook on technical analysis. This was not a video about technical analysis, but that is objective data that is excellent to have when you're trading short-term. And I also have a subscription service for alerts and my weekly newsletter. So if you're interested in any of that, definitely give me an email. Or you can message my wife on StockTwits, Mrs. Black Ink Economics. Or you can find me on Facebook, Black Ink Economics on Facebook. All right, everybody. Thank you very much. And I'll see you next time.